Hello guys, welcome to lesson 3 of module 1 of our course. On this lesson we're going to talk about basic elements, so a trade setup and market maker conditioning. Alright, so we're going to discuss basic elements, so trade setup. Now, for every trade idea in the marketplace, there needs to be context or framework surrounding that market idea. We have number 1, expansion. We have retracement, we have reversal, and then we have consolidation. Now, the above 4 are the 4 market delivery profiles. Now, this is the 4 states of market delivery, but actually it is the 4 market delivery profiles. So if you go on any asset, any instrument, and you look at the delivery profile, you're going to see it's either going to be expanding or retracing, or in a consolidation or reversing. So just no market profile outside these 4 market profiles. So the 4 market profile delivery mechanism we have is expansion, retracement, reversal, and then consolidation. Now, in relation to these 4 market profiles, we assign an institutional reference point salient to each of them. So this essentially means that for each of the delivery profile, there's going to be a relevant institutional reference point to each of them, and we're going to discuss that on the next slide of this presentation. For expansion, we assign order blocks to them. For fair value gaps, we assign inefficiencies. For retracement, we assign inefficiencies. Now, when I say assign, I simply mean that your focus goes into fair value gaps and inefficiencies when the market is in a retracement. When the market is expanding, your focus goes into order blocks. When the market is reversing, your focus goes into liquidity pools and stop runs. And then when the market is at consolidation, we are primarily viewing equilibrium in price. Now, what we're going to do here is we're going to go on each of these concepts and we're going to build upon them. So by the end of the lesson, you should have a holistic view of market delivery profiles and the reference point which are salient to each of them. So we're going to start first off with expansion. Now, what is salient to expansion is the institutional reference point salient to expansion is order block. It could be a bullish order block, it could be a bearish order block. Now, with expansion in the marketplace, expansion by definition is when price moves quickly from a level of equilibrium. Now, when we say move quickly from a level of equilibrium, we're talking about a level of consolidation. So what I define consolidation from an institutional perspective is consolidations are areas of stable flows of liquidity, meaning the market is in a stable flow of liquidity, and then we have flows of volume coming to the market at that price until a large order comes into the market at that consolidation, which triggers the expansion. Okay, when we see expansions, we are concerned with order blocks, because what we're concerned with is the accumulation or distribution inside the consolidations. Now, when we talk about the accumulation or distribution inside consolidation, what are we primarily focused on? Going back into our definition of what order blocks are areas of institutional accumulation or distribution, right? So when we see expansion from a range, we define the order block prior to that expansion inside the range, and that becomes our point of interest going forward, because if the market returns back down into that order block, that should be a level of continuation of market delivery. Why? Because inside the expansion, remember, we have flows of liquidity coming into the marketplace until a huge contract comes into the marketplace, triggering what I call best bid, best offer, which causes the market to expand algorithmically. Now, that candle or that down candle prior to the higher expansion, or up candle prior to the lower expansion, that's our order block, and that's our area of interest, because that was the level where we had that order come to the marketplace that was used to trigger the expansion price. So if the market returned algorithmically back into that range, we are concerned with the last candle prior to the expansion out of that range, and this is where we concern ourselves with the order block. So the order block is salient to expansion because that is the level of institutional accumulation or distribution. When price leaves the level quickly, this indicates a willingness on the part of the market maker to review their intended repricing model. That's all we're doing. So all we're doing is we're going back to where the accumulation or distribution was done institutionally, and we're using that to frame our own setups. So when we identify expansion from areas of consolidation or areas of what I call stable flows of liquidity in the marketplace, we're primarily concerned with the order block. The order block that the market makers leave at or near the equilibrium of a trade range, that is what is salient to us as institutional traders. Now we're going to go into the next market delivery profile, which is retracement. And unlike expansion, with retracements, we're more primarily concerned with liquidity gaps and inefficiencies. So what I'm going to do here is I'm going to pull up a random chart, and we're going to do some annotations to describe the lessons I'm teaching on this presentation. So we're going to go out to a daily time frame, and we're going to minimize this. Okay, now this is what I call a stable flow of liquidity. That's a trading range. Okay, so let me get rid of this real quick. So we have stable flows of liquidity. The market is moving sideways. So this is a consolidation. The market is neither going higher or lower, it's just moving sideways. Now typically what's going to happen is if we are poised to expand higher, you're going to have a bearish candle here. I'll make that black so you can see that conceptually. So we have a down candle, and then we have an expansion out of the range. Now remember, in our market delivery profile, when we see expansion in price, our eyes goes back to the preceding down candle prior to the expansion higher, because that is going to be our bullish order block where institutions were able to accumulate orders in the marketplace before the algo starts to drive the market higher. So if the market returns back into the consolidation or the base of liquidity, we expect a bounce from there. So just my OCD is playing up right now. So when the market returns back down into that initial consolidation, what we're looking for a bounce. Why? Because institutions accumulated here previously. So when the market gets back down there, they're going to reaccumulate there. Why are they going to reaccumulate there? Because the institutions cannot get in all their orders at once due to the size of the volume they are transacting with. So the market has to return back down into an old level of institutional buying for them to reaccumulate. Okay, so they will go in gradually and build in positions. That's how institutions build in orders. When I say institutions, they are different from you and I. You and I, we're retail. Our orders are not large enough for us to go into the marketplace and be delayed with a fill in price. Okay, these people are trading interbank price feeds, right? And what they're doing is you're accumulating gradually into the marketplace. Meanwhile, even you might think 100 lots or 500 lots, they're huge lot sizes, but that is to retail sizes. That does not even measure up to institutional sizes. Okay, so based on the volume of these institutions, they have to go into the marketplace gradually, and they cannot go into the marketplace at once. So that's why the market has to return back down into that initial range of expansion. So whenever we see expansion out of a consolidation or a range, we're primarily focused on the order block, because that was an area of old institutional buying that they are going to reaccumulate at, because they've shown evidence via this expansion, which we call institutional sponsorship. Okay, We're going to talk more on that on a different lesson. But they've shown evidence that they want to price the market to a level that there can be counterparty transactions. Now, when we talk about retracement in price, Terry, I want to get water, and I think this might possibly be a long conversation with you guys in this lesson, so I need to have water beside me. Now, from expansion into retracement, when we get to retracement, we're dealing with primarily liquidity gaps and inefficiencies. Now, I'll explain why. When we have expansion out of this liquidity base or consolidation, when we have expansion out of that, okay, what's happening is the market does not drive higher because of the accumulation here. Now, a lot of times when you look at expansions, you're going to see they're oftentimes very inefficient. So that means the delivery higher is going to have a lot of liquidity voids in form of fair value gaps, CVs and BISs, actual market gaps, and volume balances. Now, the reason why is because the algo is what drives the market higher. Why is the algo driving the market higher? Because the algo is seeking a point of counterparty liquidity. Now, let us define what counterparty liquidity is conceptually. So we're going to call this counterparty liquidity. Now, let's define this. All right, so what is counterparty liquidity? If the institutions are accumulating down here, they have to distribute their orders. If they cannot distribute their orders, they remain stuck in price. They remain stuck in the market delivery, and they cannot exit. So their profits or loss might be flashing, but because there's no counterparty to their liquidity, there's no way for them to exit. So what the algo does is, when the algo is triggered due to an influx of order coming to the marketplace, the algo has to drive the market to a point where there can be counterparty liquidity, meaning where institutions can then distribute their previously accumulated positions at a profit or at a premium. So when I say at a profit, we're talking about a premium, right? So if you're buying at a discount and you're selling at a premium, you're making money. If you're buying at discount, if you're buying a premium and you're selling at discount, you're losing money. Okay, so the institution will accumulate at discount, and then they will reaccumulate at discount, and then they need the market to get up into a level of premium for them to offset their previously accumulated positions. Okay, so what the algo is doing is the algo is driving the market to a point where there can be counterparty liquidity to the orders of these institutions. So this is where we term counterparty liquidity. Now, the market driving higher is not due to give me 1 second real quick. All right, so excuse me. Now, when we are driving up into this point of counterparty liquidity, the market is not doing that because there is real orders coming to the marketplace to drive the market up into a level of counterparty liquidity. All that's going on there, it's all artificially driven prices that's going on there. The market is driving the price to a level where institutions can exit or distribute or offset pending liquidity. Now, what's going to be the pending liquidity? It's going to be that area of accumulation. So they have to set that accumulation area against opposing orders. So meaning, if the market is driving higher and institutions have accumulated down here, then price is driving to a level of buy side liquidity. Why? Because that buy side liquidity up there, if the market gets up there, then institutions can pair their accumulated orders against willing buyers. So the question is, who's willing to buy their orders from them? That's why the algo drives the market up to a level of counterparty liquidity. Now, that counterparty liquidity, which we call buy side liquidity, can be in form of an old high or a premium inefficiency. Now, premium inefficiencies are also termed buy side liquidity, but we call them secondary buy side liquidity. Discount inefficiencies, we term them sell side liquidity, but they can also be called secondary sell side liquidity. All the algo is doing is the algo is driving the market out to an area where there can be facilitated transactions. So now when I state that the market is driven based off of transactions, this is essentially what I mean. The algo is constantly driving the market to areas of inefficiency or areas of liquidity to either facilitate a transaction or to be counterparty to a pre-existing transaction in the marketplace. And the pre-existing transaction, this example, is going to be our long or accumulated orders inside this liquidity base or consolidation. Now, when we are dealing with inefficiencies in the marketplace, we're primarily concerned with when we're dealing with retracement in the marketplace, we're primarily concerned with fair value gaps and inefficiencies, or it could be liquidity voids. The reason why is because when the market is expanding out of that range, it's going to do so inefficiently because, again, it's not driven by orders. It's being driven algorithmically or artificially. So you're going to have a lot of porous price action, missing an influx of orders in the marketplace. In retracement, the market is seeking to rebalance the inefficient price delivery because that's the way the algo was designed. So the market or price will retrace because it has to go and rebalance areas of inefficient price delivery in the run higher. So this is why we're concerned primarily with fair value gaps or inefficiencies. So those inefficiencies could be liquidity voids, it could be volume imbalances, but that's what we're primarily concerned with. So when the market retraces down into those levels, then interbank traders will come and repopulate that inefficient price delivery with orders for then continuation expansion into a point of counterparty liquidity. Okay, so this is the importance of inefficiencies in market delivery. They're primarily focused on retracement in price because the market has to redeliver to points of inefficient price delivery. The process of the market retreating lower to seek points of fair value, that's what we call redelivery. So this run lower, algorithmically speaking or institutionally speaking, we call them redelivery. So the market is being redelivered to points of inefficient price delivery to then facilitate higher expansion after we have a balanced range of delivery, okay, or an efficient range of delivery. So when we deal with retracement, we are primarily concerned with liquidity gaps and inefficiencies. In retracement, we are identifying areas of inefficiencies in the marketplace that the market can reprice to continue order flow. So this is where our focus goes into. So when price retraces inside a recent price range, that indicates a willingness on the part of the market makers to reprice levels now efficiently traded for fair valuation. So I think on lesson 7 or 8, lesson 6 actually, we'll talk about fair valuation. So we're going to talk more on the idea of fair valuation, and that's where we go in detail into what inefficiencies are in the marketplace. Now we go into the next market delivery profile, which is consolidations or equilibriums. Or sorry, reversals. Okay. Now we're going to talk about reversal. In the reversal market delivery profile, we're primarily concerned with liquidity pools. Now let's define what reversal is. Reversal in price is when price moves the opposite direction that current direction has taken it into. So if current order flow was bullish, reversal will be the market going from a bullish delivery state to a bearish delivery state. If current market profile or market delivery is bearish, then reversal will be the market shifting from a bearish delivery state to a bullish delivery state. When we discuss reversals or when we identify reversals in price, we are primarily concerned with liquidity pools, and this is where rejection blocks can also come into focus. A lot of times prior to a reversal, you're going to get a run on stops, which we call stop runs. Okay, that's a run on an old high, or that could be a run on a rejection block, but that still is a stop run. In reversals, we identify the liquidity pool above an old high or below an old low. And just to view that conceptually, what reversals will look like and why we're primarily interested in liquidity pool. Remember, reversal is going against current market delivery profile. So if the current market delivery profile is bullish, then we're going to have counterparty liquidity up here, because then before we can shift current delivery profile, pending or current liquidity profile has to be exited in the marketplace for a new delivery profile to occur in price. Okay, so that means if we have an institution supported range here, before we can shift to a bearish delivery profile, there has to be a point that this accumulation here, a discount, can be distributed against. So what you get in the market is going to run up into a level of counterparty liquidity, and that's going to be a liquidity pool in form of an old high typically. So it could be a rejection block, or it could be just an old high. So we're going to call this old high or bearish rejection block. There. When the market gets up there into that bearish rejection block or old high, then we can then see distribution of accumulated positions down here. And if the institutions want to be bearish, then they can distribute positions up here and start the new delivery mechanism lower. Okay, so prior to a reversal, we are primarily concerned with runs and stops. If I went to any random chart and let's say I put up a new chart and we look for any random chart in price, so I'm gonna use let's use USDJPY. That's a pair I never trade, so we can use that for example. So if we use a pair like USDJPY for example, and let's see if this can load up and get going. So what we're going to do is we're going to identify every reversal point, and you're going to see that majority of the reversal points come after a run on stops. Okay, after a stop run or after a run on the liquidity pool. So we're going to identify USDJPY. We're going to use wind the price fit. Again, this is a daily time frame. It's not necessarily any time frame, this is still salient because price action is fractal. All right, so now prior to this run lower, from we had a bullish delivery up here, then the market trades lower. Prior to this run lower, look at the run on the rejection block here. So we have a rejection block there. The market gets very close up into that and then sells off. Plus, we also have a consolidation here. That is a range of consolidation, and then we break higher, sucking everyone into thinking this is going bullish, and then we aggressively run lower. Recently, we just had a reversal on the daily time frame. Prior to this reversal higher, we had a run on sell stops. That is the low here. You can see we run below sell stops, and then we start to reprice higher. If you go all the way back and if you look at every short-term run lower, like this for example, we have a run on buy stop. Look at the run above the rejection block here. Same thing here. Before we run higher, we had a run on buy stop. So this is a reversal lower. It's reversing from this initial short-term bullish delivery into resuming the higher time from bearish delivery. Also here, it's reversing away from the short-term bullish delivery and continuing the higher time from bearish delivery. Down there. Alright, so every time you have a reversal in price, you have a run on stops. Here, for example, you have a run on sell stops there. Then the market starts to run higher. We have a run on sell stops here and here, and then the market starts to run higher. Before the market retraces lower, you have a run on buy stop. So I'll zoom in a little bit and then you can see what I'm talking about. That is a rejection block there. You have a run on buy stop, and then the market runs lower. Now the question is, when do you know if the market is going to run a rejection block or it's going to run an old high or an old low? That's the question. Well, you have to realize that rejection blocks, they are areas of volume, and primarily the funds are going to be dealing with the volume of transactions in a range. So if they are going to have protective stops above a short-term high or short-term low, they're primarily concerned with the bodies of the candle, because that's where the bulk of liquidity in a market delivery, that's where it is focused at. Okay, so a lot of times just running the volume, or sorry, running the rejection blocks above an old high or an old low, especially on the higher time frames. So rejection blocks, you're more salient on the higher time frames because this is where the institutions are primarily focused on. Now on the lower time frame, they're still also salient, but on the lower time frame, you're more privy to run old highs and old lows versus the higher time frames where just running the rejection block is enough for a reversal in price. But just from the example, going back into what market reversals are, or when we deal with market reversals, we're more concerned with the liquidity pools, and in reversals we identify the liquidity pools above an old high or below an old low for the market to run into. Now for a reversal to be salient, we have to couple that with another PD array. So if we're looking at reversals in price, there has to be a confluence of factors that comes to the marketplace for that reversal to occur. So that could be either a COT analysis or an open interest analysis or a seasonal tendency or an SMT against a correlated asset. Okay, but we don't just go every run above a liquidity pool is a reversal. That's not how it works. Okay, it has to always be in concert with something else. And that's how we identify a reversal. But when we have a market delivery on the way, or what I like to call an order flow on the way, every run above a short-term high, we don't view that as reversal. We view that as a break in structure, and we anticipate a retracement back into the previous range, identifying points of inefficiencies for the market to continue order flow. So if I go back to that old example of USJPY and we look for retracements in price when a new order flow was on the way, you're going to see the run below short-term low is not a reversal. The run below short-term low is simply a break in structure for a potential retracement back into the range for a continuation of market delivery. So I don't know why this is taking a while. Well, we're gonna look at USDJPY and we're going to identify the price delivery mechanism and see if we can catch the reversal profile, the retracement profile, and also the expansion profile. That's what we're looking for. So we're gonna look for USDJPY here. Daily time frame. Again, you can use any time frame. The concepts are universal because it applies to all time frame. 5-minute time frame, 1-minute time frame, 15-second time frame, 10-second time frame. Regardless, it's the same thing. All right, so you can see we run into rejection block prior to reversal. We expand lower. Then after expanding lower, we have a smaller retracement. It gets very close to this inefficiency up here. But if you went to a lower time frame, you see there was an inefficiency the market was actually referencing. If we get to a lower time frame, and then the market breaks lower, and then after breaking lower, we have what we call expansion. In the retracement, it's going back to an area of fair value here. That is an area of fair value. That's a bearish fair value gap. And then the market sells off and goes lower. Expansion. Now it's retracing. Where is it retracing up into? It's retracing up into an area of fair valuation here. Then you have expansion again. Then it's retracing back into an area of fair valuation. That is this sell side imbalance by inefficiency. And then it sells off. Now it is retracing above the short term high. How would we know that this is not a breaking structure? Because order flow is bearish, and we still have an higher time from liquidity to reach out and take out. And this, so the market is not just going to come down here to this low and then reverse, okay? Because there is huge orders resting below this initial trader range here. So we're going to use a horizontal line to delineate that range there. Okay, it's not just going to come down there running shallow and then reverse. So when we see this run higher, that is a reversal in price to then continue. Okay, so this run higher above the rejection block, that is a reversal from this short-term bullish delivery to resume high time from bearish delivery. And we're looking for a run below that short-term low there. And after we run that short-term low one more time, then we see a reversal in price. The market runs low, again runs sells liquidity, retraces back down into consolidation. Again, we have a consolidation prior to an expansion here. All right, so we have consolidation, expansion out of that consolidation. Where we return back into? Well, the order block preceding the expansion. That's what we're interested in. So expansion, retracement into liquidity base here. And then the market shifts delivery. Then you have a retracement into inefficiency. The market continues higher. Now let's talk about consolidations. When we're dealing with consolidations, we're primarily focused on the equilibrium of a trading range. So consolidations and equilibrium goes together because orders inside a stable flow of liquidity, or what I like to call a consolidation, orders will be built around the equilibrium of that trading range. That's what you're going to get. So I don't know why I keep canceling the USDJPY tab. But if I went back to the USDJPY tab and I showed you that recent chart I just showed you using consolidations, you're going to see around the middle of the range is where you're going to get the bulk of orders being built. And you see that conceptually. Okay, so I want to stick with the same example and use that to conceptualize the ideas we're talking about on this lesson. Before we get the chart loading up, I don't know why for some reason my mobile connection is slow today. Starlink just went out, so I'll probably go and check what's up with that one and see why the router went off. But for now, we're just gonna use my mobile data to connect to the internet and see if we could get something for today's lesson. And also, if you hear me drawing my nose, that's because I'm kind of sick, and I'm currently on medications and stuff. So I apologize if you hear me just draw my nose on the session, but there's nothing I can do to avoid that, unfortunately. Now let's define what consolidations are. Consolidation is when price moves inside a clear trend range and shows no willingness to move significantly higher or lower. So in other words, consolidation is what we call sideways movement in the marketplace. So the market is neither trading higher or trading lower, the market stays flat. That is a consolidation. Now, inside a consolidation, orders will be built or stacked inside the equilibrium of the trading range. So when you define a consolidation, you take the highest high and the lowest low of that range, divide it in half, or what I like to call 50% of the range, and that gives you your equilibrium of that trading range. Now, at the 50% of the range, that's what we call the mean threshold of the range. Inside the mean threshold of the range, orders will be built around that mean threshold because that is an average price that the institutions can get to build in positions. I know that was a lot of talk and that might not make sense, but what we're going to try to do is we're going to try to bring everything together. Okay, so I'll end it here at part 1 of the market maker conditioning and market maker profiles, and I will resume the next lesson shortly, and we're going to continue from where we left off. Be safe.